For years, quantum computing has been treated as a distant concern for crypto, something theoretical, something for later. But that assumption is starting to break down. Multiple quantum computing roadmaps from different companies and research institutions are converging on a similar timeline. They suggest that breaking elliptic curve cryptography, the foundation of most blockchain security, could become technically feasible around the early 2030s. Not guaranteed, not certain, but realistic enough to matter. And one key reason is algorithmic acceleration driven by AI. Quantum hardware is still noisy and imperfect, but better algorithms dramatically reduce how much hardware is needed to reach practical attacks. That changes the risk calculus. Now here's the critical point. Markets don't wait for certainty. They react to credible threat perception. Institutional investors don't need quantum computers to actually break cryptography before they move. They only need to believe the risk window is approaching. And when you look at today's crypto ecosystem, that belief matters a lot. Over the past few years, stablecoins have become the backbone of on-chain liquidity. They are the primary trading pair for Bitcoin and most digital assets. They are also the main vehicle institutions use to deploy capital into DeFi strategies. But institutional capital behaves very differently from retail capital. If you're managing hundreds of millions of dollars, earning an extra few percent on-chain only makes sense as long as the tail risk is acceptable. Quantum risk is a tail risk, but it's a catastrophic one. From an institutional perspective, the trade-off starts to look uncomfortable. A few extra percentage points of yield versus the possibility of a total loss due to cryptographic failure. And importantly, traditional financial institutions are already moving. Banks, payment systems, and even web infrastructure are actively working toward post-quantum cryptography. They don't have decentralized governance. They can upgrade quickly and proactively. So imagine you're an institutional allocator watching this unfold. You see credible quantum roadmaps. You see AI accelerating cryptographic research. You see that blockchains are still debating, experimenting, or underfunding post-quantum migration. You don't need a quantum breakthrough to act. You simply move stablecoins off-chain and park them in quantum-safe banking systems until there's clarity. If that happens at scale, the impact is severe. Liquidity doesn't just leave Bitcoin. It leaves Ethereum. It leaves Solana. It leaves DeFi as a whole. This isn't a Bitcoin-only issue. It's a system-wide liquidity risk. And that's why post-quantum cryptography is not a technical detail. It's a strategic priority. Blockchains that demonstrate a credible, well-resourced, and measurable path toward post-quantum security will likely attract liquidity. Chains that don't will see capital hesitate or exit. In that sense, post-quantum readiness may become one of the strongest drivers of relative valuation between networks. Not tomorrow, but much sooner than most people expect. The problem today is mispricing. The ecosystem is spending almost nothing on post-quantum migration relative to the scale of the risk. If you assign even a small probability to cryptographic failure, the rational level of investment should be orders of magnitude higher. Right now, it isn't. And that gap between systemic risk and preparation is where instability forms. The takeaway is simple. Quantum computing doesn't need to arrive to matter. Belief is enough, and liquidity always moves first.